Hi and welcome to Swissquote's Daily Market Talk. It's Friday, June 19th. Market feelings are mixed this morning. On one hand, the falling oil prices on the interim peace deal between the US and Iran gives hope that inflation will ease and keep central bank policies from further tightening. But on the other hand, a stronger US dollar broadly counterweighs the benefits of falling oil prices for economies outside the United States. Inside the US, the interim deal with Iran came as a shocker, obviously, given the very advantageous terms for Iran. Hence, a peace is not a done deal just yet, but the stronger US dollar today is an emerging headache. So we will talk about all that and more. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So the interim peace agreement signed between the US and Iran this week got oil flowing through the Strait of Hormuz and echoed quite positively across global financial markets yesterday, making investors forget about the previous day's hawkish Fed announcement for a minute. US crude shortly dipped below the 200-day moving average in yesterday's trading session. That's near the $74.80 per barrel level and consolidates just above the $76 per barrel level at the time I'm talking here this morning, as the two countries, the US and Iran, begin a 60-day negotiation period today. So if the tensions remain low, the US crude could eventually steady within the $60 to $80 per barrel range for the next 3 to 6 months and could eventually return below the $50 per barrel mark within the next 12 months. Because lately, the IEA has become increasingly vocal that once the Middle East disruption phase and flows normalize, the oil market is likely to swing back into a substantial surplus in 2027. Note that before the Iran war, the IEA had been projecting a surplus of nearly 4 million barrels per day for 2026, driven by strong supply growth and relatively weak demand growth. Today, they point at a 5 million barrels per day surplus. Indeed, the 3-month conflict in the Middle East and the latest spike in energy prices boosted demand for alternative energy sources. And on that subject, against all odds, the clean energy funds have been performing nicely since Donald Trump returned to the White House at the beginning of last year, slashing everything that has to do with clean and green energy. But the last Nasdaq's clean energy fund is still up by 186% since the April 2025 dip and has recovered 2/3 of its post-2021 losses. And it is not the only well-performing clean energy fund. Moving forward, the energy transition will continue to develop and will probably attract more funds with or without Trump. But Trump's Middle East war has clearly been a boon for the alternative energy providers, reminding everyone that the energy security could only be reached by alternative sources for the countries that do not have the traditional energy sources like Europe. Now, coming back to peace negotiations, they won't be a walk in the park, unfortunately, as Iran will hold on to its nuclear program, whereas the United States, having made an incredible amount of concessions to bring Iran to the negotiation table, has got very little margin left today, and it's also got Donald Trump. Not reassuring at all. We just learned this morning that negotiations in Bergenstock in Switzerland that were due to start today, this Friday, will be postponed to an ulterior date without much information regarding why. So the peace deal is not a done deal yet, and the $300 billion reconstruction fund for Iran gave a touch of nausea to US bondholders yesterday after the details of that interim peace deal were released, keeping the upward pressure on US yields along with the Federal Reserve's hawkish stance earlier this week. So the markets don't know how to react to all this. Falling oil prices is obviously good news, but the US dollar's appreciation somewhat counterweighs a part of that relief for other economies outside the United States, as energy and other commodities are negotiated in terms of US dollars, and a more expensive US dollar makes energy and other raw material imports more expensive for global markets. The US dollar, on the other hand, is supported today by a notably more hawkish than expected Fed announcement earlier this week, with the new Fed chair, Mr. Kevin Warsh, insisting on the price stability in the US, highlighting that the prices in the United States are hovering above the official inflation target of 2% for half a decade now, and something needs to be done to bring this inflation back to the 2% mark. So it goes without saying that a rate cut is not the solution. On the contrary, to bring inflation lower, you will need to tighten the monetary policy. As a result, we see yesterday's relief rally in financial markets on interim US-Iran deal vanish this morning. Nikkei is pulling back 1.45% from an all-time high level at the time I'm talking here, while the Korean Kospi index sharply erased earlier gains and is down by more than 1% right now. High volatility remains the name of the game in South Korea and its highly popular memory chip makers. And if the global market sentiment further deteriorates, well, the South Korean index will probably be subject to a further volatility. In the US, the news that Intel will be producing the Apple chips on the US soil gave the stock a nice boost yesterday, sending it to a fresh all-time high level indeed and pushing Van Eck semiconductor ETF to a fresh high as well. Yet US futures are in the negative territory at the time I'm talking here this morning under the pressure of rising US yields. Speaking of US yields, the US 2-year yield is consolidating a touch below the 4.20% level this morning on expectation that the Federal Reserve could hike the interest rates, and it could do it as soon as September. Activity on Fed Funds futures suggests that September rate hike is now given more than a 70% chance. Elsewhere, yesterday, the Bank of England and the Swiss National Bank left their monetary policy rates unchanged. The Swiss actually confirmed that there was no need whatsoever to hike the interest rates when inflation in Switzerland is comfortably below the 2% policy target, while in Britain, the British policymakers said that the recent pullback that we saw in oil prices was somewhat comforting. Yes, but they still warn that even in the event of prompt conflict resolution in the Middle East, there could be a logistical delay in restoring energy production and transportation. So cable died below a critical Fibonacci retracement yesterday, which is the major 38.2% Fibonacci retracement on 2025 to 2026 rally, hence stepped into the medium-term bearish consolidation zone. The bearish move is also supported by the hawkish divergence between the Federal Reserve and the Bank of England monetary policy outlooks today, suggesting that we could see a deeper fall in cable toward the 130 psychological mark, which also coincides the 50% Fibonacci retracement on last year's rally. Across the channel, the US dollar's appreciation also pushed the euro dollar below the 115 psychological mark. The critical support here lies near the 113.45 level, which is the major 38.2% Fibonacci retracement on the euro dollar's own 2025-2026 rally. Here as well, the Fed's hawkish divergence will likely play in favor of a deeper pullback in the euro dollar toward and potentially below that level. And note that euro's depreciation will also keep inflationary pressures in the euro area sustained and could encourage a more hawkish European Central Bank stance moving forward. But unfortunately for the euro area economies, the dull and the bleak growth outlook will be a limiting factor in how far the European Central Bank could turn hawkish, and that will also limit the euro's potential to rebound against the US dollar today. That is pretty much the same scenario with the UK growth story, but on top of the economic troubles in the UK, well, the UK is now about to enter a new period of political instability, with Mr. Burnham's coming for Starmer's seat after his victory yesterday. He's in favor of more fiscal spending, which is bad news for the UK's gilt markets and for the Bank of England as well, that might have to do a part of the heavy lifting moving forward by adopting a more hawkish monetary policy tone than otherwise. You will have time to dive into that story in the coming weeks. But for now, let's move to the precious metals before we close the week. The rising US yields today increase the opportunity cost of holding the non-interest bearing gold, and hence will likely send the price of an ounce below the $41.15 per ounce mark, which is the major 38.2% Fibonacci retracement on the latest bullish trend that started back in October 2023. Now we are just close to that level, and we could see the bullion return to $3,500 to $4,000 per ounce range in the continuation of this deflating speculative bubble without, however, damaging the gold's multi-year bullish trend. Now, in the short run, the US dollar's appreciation could accelerate the gold sell-off if especially global central banks continue to sell their gold holdings to stabilize their currencies. But in the longer run, they will be replenishing their weakened gold reserves, which will keep gold demand intact in the medium to long run as US latest military ambitions and additional pressure on the US debt as a result of it will also encourage a further replacement of the US treasuries by the yellow metal from the major institutions like the central banks. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button to let us know that you enjoy these videos. So I will meet you again next week, and until then, good day trading and have a lovely weekend.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.